Welcome to Advisor Wars, the podcast where we take a critical look at the key issues facing the financial advisor profession. I am Bob Hoocher, and co-hosting with me is Joe Halpern, Managing Partner and Chief Investment Officer of Obsidian CIO. I was the founder of Advisor Perspectives and led it as its CEO until 2024. This is the 7th episode of Advisor Wars, and with it, we begin a new series with episodes that focus on the role of tax planning in the advisory profession. Joe and I will explore why taxes could be the last great differentiator for RIAs. You will learn how tax integration strategies help elite RIAs, help differentiate them from commodity advisors. So setting the stage, Joe, let me ask you, what has changed in the last 3 to 5 years that makes tax integration more urgent?
Thanks, Bob. And before getting into what changed, it's important to just stress that tax is one of your top 2 lifetime expenses, just depending on your net worth. So it's housing and tax, 1 and 2 always. So this is a really, really important topic. And Parametrics back in the day really put a bit more focus on, I'll call it tax efficiencies within portfolios through really democratizing tax harvesting, direct indexing, and we'll talk a little bit more about that. And I believe the urgency that you mentioned, Bob, is there because there's more innovations that have come into the advisory space over the last few years. A couple of examples, long-short tax extensions by the like of companies like Quantino, AQR in Brooklyn. Some innovations on exchange funds by a firm called Cash and another by Calamos within ETF. So there's more and more capabilities from an asset management perspective that can assist in taxes. And then at the same time, tech keeps on marching along. And so there's more and more capabilities within the better tech stacks to take advantage of, I'll call it strategies broadly within the advisor space. So I believe it's taken on more urgency because there's tools there that people are starting to hear about that are worth using.
You mentioned that Parametrics has democratized or was a leader in democratizing the role of tax planning. Are we heading toward a world where tax integration is just table stakes, or is it still a premium offering?
I believe it will stay a premium offering for quite a while. And if you go to, let's break down tax harvesting. So what tax harvesting does predominantly, folks are focused on direct indexing. So Parametrics, as you mentioned, as I mentioned, it's democratized the space a lot, really brought it into the space. And what you're doing there is you're taking a sample of an index, take the S&P 500, and instead of buying SPY, maybe you're buying 200 tickers, 300 tickers. And some of those lose. They go down instead of going up. And those that go down, you're essentially selling them and you're replacing them with a similar ticker. So similar in characteristics to what you sold. And therefore you're generating losses while still participating in the S&P 500. And arguably you want to have exact participation in the S&P 500. And that allows you to defer taxes. And you could potentially, depending on what you're doing, defer taxes forever. You really can. There's a method to get there all the way to a step up on death into the next generation. So there's all these little tools that happen. And so it's really powerful. And coming back to your question of premium versus table stakes. So now if you go to a TAMP, a lot of times you'll see a model portfolio, and underneath it, when you're setting up your model, there's a little button there, and you could check mark the button and you could pay an extra 6 basis points and you can get tax harvesting on your model. And that right there are table stakes. So tax harvesting in a lot of ways are table stakes. If your advisor's not doing it, you should ask why not. I'll note that It's not automatic that you need tax harvesting, but it should be thought about of should I use it or should I not? In other words, all the tools should be at one's possessions, be able to access any tool you need. And then it comes down to, should I use this tool or should I not use this tool? Going to premium products, some, as I mentioned before, you have these long, short extensions, which are pretty powerful tools. I'm not going to get into it. You can always reach out to us at Obsidian to learn more about them. But it's the next level. It's more complicated. It's more complicated in deciding what portfolios should use it at what levels. It's more complicated. How does it work? And then incorporating it within a portfolio. And then you could just really go down a rabbit hole of how to create more tax efficiencies by truly integrating tax into your practice. And those are just really premium because it's just, you have to be thoughtful about it.
Now you mentioned that one of the areas where you add value is figuring out where taxes fit into a practice. But you're an outsourced CIO. From the standpoint of an OCIO, where does tax management actually show up in portfolios?
Yeah, it's a great question. The answer is everywhere, right? Placing exposures in the right accounts, taking advantage of tax harvesting when one can, and really going down that rabbit hole. And when you step back for a moment, our partner advisors' jobs are to be out there every day, creating and building on relationships that they have. And part of that is holistic planning on behalf of their clients. And that job's becoming more and more complicated as more products come out and there's more sophisticated tools there. Our last series, we talked about alternatives. You have to have a view on alternatives. And so advisors have a tough job. There's a lot going on that they have to stay on top of. Our job is to focus on portfolio design and portfolio management. And that's where we spend all our time. So while the advisor's going and doing what they do best, we're sitting there and saying, how do we integrate tax? Understanding that tax is one of a end client's top 2 expenses lifetime. How can we mitigate that? All right. And by using tax, there's all these benefits that accrue to the client, not always in form of a deferred tax or lower taxes, but sometimes in the form of, hey, guess what? We were able to generate some losses, and that's going to allow us to better diversify your portfolio for the long term, right? Sometimes it makes sense to take a gain to make sure that you don't have too much of a concentration in one area of the market or another. So all these tools create that permission and that capability to efficiently manage to a risk parameter and to an individual person's financial path.
You mentioned a few tax strategies from loss harvesting to long short positions. What are the highest impact tax strategies that advisors should prioritize first?
So one of our core, I'll call it philosophies or first principles, is dotting I's and crossing T's. There's all these simple things that you just need to do. And I'd say the first step for an advisor in prioritizing, just making sure all those accounts are properly set up. If you got a 401k match at work, max that 401k match, take advantage of 529s, HSAs, all those items. That's where an advisor should start, because sometimes it's like, you don't need to get really into the super complicated products to really make a difference for your clients. And sometimes it's just right there in the beginning. So we, as an example of that dotting I's and crossing T's, spend so much time on cash management. Could we get an extra 10 basis points of yield at a similar risk parameter? Of course, is all cash being efficiently used within an account? And it sounds easy, but it's actually pretty hard, and it's really important. And if you think about just an individual, money hits an account, they're busy, they have a trip in a week, their kids are yelling, whatever it is, and then you just have money sitting around not working for you, which means given that inflation is positive, you're losing money. So that dotting I's and crossing T's is so important. And that's where I'd say an advisor should prioritize. And then you could go from there.
A large part of your offering is based on technology. What tools or systems are essential for delivering tax-aware portfolios at scale?
It's a great question. So this is a very similar theme to some of what we've spoken about on the Alt Show, where at some point everything was about model delivery, and models were compartmentalized. They're simple to deal with. And so from that perspective, you just didn't need a ton of tech. This stuff's complex. So for example, us at Obsidian, we've built a whole tech stack underneath to manage that complexity. On the back end, it's complex. On the front end, it's sophisticated, right? We're using alt, we're using tax, we're incorporating all of it into our portfolio on behalf of the end client. And so you just do need more tech. If you're going to invest on your own, you have to ensure that all the components are talking to each other, you're sleeving correctly, and just understanding where cash is flowing in and out of, because there are cash flows in just dealing with these different tax strategies.
You mentioned earlier that on some systems you can check a box and pay 6 extra basis points to get tax loss harvesting. Do you see tax integration as a way to justify higher fees, or is it a way just to defend your existing ones?
Yeah, so our view is that there is downward pressure, and I think this is a general view. I don't think we're sticking out here, that there's generally compression on fees. And it's interesting because over the last few years, I haven't heard that. It hasn't been as prevalent in the space as it was, call it 5, 6, 7 years ago. But there's always downward pressure on fees across Wall Street, by the way. It's not a financial advisor thing. It's across Wall Street. And some of that downward pressure is due to the upward march of technology. Most of our advisors use Schwab as a custodian, and Schwab was one of the first, right? They were a low-cost broker back in the 70s who created access for individuals to trade securities. And at some point, they were charging an arm and a leg. You could make a living simply buying Apple and selling Apple for people, and that is no longer the case. So there's just a march down in fees. And so to us, the equation is, if you're not doing anything new, your fees will just continue to erode. But if you add services and solutions, your fees will maintain. They won't go down. And so that's what we've done. We are here, we're thinking all day, every day, about how to incorporate appropriate solutions and services within portfolio management and assist our partner advisors. And we have not seen fees erode. We've seen them been pretty static, but I think if we didn't continue to increase our services and think about our services and provide best practices, I think those fees would erode.
I assume it's essential for our clients to think of their returns in after-tax dollars, because that's, after all, that's really what matters to them. How do you educate clients to think that way?
Yeah, I mean, a client really needs to think about net after-tax returns, and it's a great question, Bob, and it's worth running it out to that statement of net after-tax returns. Sometimes a client will get caught up with, okay, why is the fee so high? But it comes down to, okay, what's the manager doing? And so using an example, SPY, S&P 500, you expect 8 to 10% returns over some long time period. About 1.5% to 2% of that is dividends. You get taxed on that 1.5% to 2%. So, but otherwise, you're just holding on to S&P, and until you sell it, there's no tax event. So it's very simple. Now let's take a more complicated scenario. Let's say you have a private manager who's throwing off a 16% gross return, where it's all paid out in coupons and income. Well, what if let's say they have a 2 and 20, but the math's probably too hard to go through on this podcast. So we'll just go with the 2% fee. So you take that 2% on a, 16% return, gross return. Now you're at 14%. And then if you're in a high tax bracket, well, now you're down at 8%. And you have to take that into consideration, right? And so, but when you look at that, the next step in taking into consideration, because you might say, okay, I'm getting 8% there, and in the S&P, I'm getting 8 to, let's call it 8 to 9. Why should I do it? Well, the stream's really different. It's more consistent. The volatility may be way lower. It's going to diversify your portfolio. So there's all these benefits. And at the end of the day, the number to look at is that net number. Don't care about like what taxes you're literally paying, right? It's all part. It all comes out at the end. So I think it's really important for clients to think of a net apples to apples number. And that's the answer there. So that's an example, I think, where you have S&P, some private product, and you could go down the rabbit hole on characteristics. Well, is it liquid enough? Is it this? Is it that? But ultimately, the point here is you should try to create some apples to apples in terms of a net return, and then look at the other characteristics that come off this product in creating an appropriate portfolio on behalf of that client.
So what matters is net after fees and net after taxes. And then I assume that you also factor in inflation there as well and look at how that affects returns. You've worked with a lot of advisors. I'm sure you've seen a lot of mistakes made when it comes to taxes. What are the most common tax-related mistakes that you see RIAs making?
Yeah, so the most common is that dotting I's, crossing T's. You need to do that work. It's something that, by the way, you could have a junior do within a practice, given someone has a junior. It's not complicated, but it's really important to do. And then I'd say the next one, Bob, is just understanding what's out there in the market. It's the same mistake that we talked about a bit on the alt side, where you just have to know what is going on in the industry. You can have the view in the case of alts. It's interesting here because this is probably a more important series than the alt series. Because in the alt series, you could say, I don't believe in alts. You have to have a reason for believing or not believing in it. What's your thesis statement? On taxes, you could not believe in taxes, but it's a reality that the government's going to charge you some amount of tax to do what they do. And therefore, it's inevitable that there is a tax bill. And so you need to understand what tools are at your disposal. Wall Street's constantly innovating. There's been some really interesting innovations over the last few years. Another theme that goes on at Wall Street forever is Wall Street is constantly democratizing, which means that they're taking products that have historically been used for institutional or large families, and they figure out, how can we bring this to the masses? They do this for obvious capitalistic reasons. So you have to be careful of what the structures look like when they bring it to the masses. But the idea is to bring it to the masses, and there should be benefit there. And there's been a lot of exciting innovation in the space. We expect there to be continued innovation in terms of products available. And then with technology, there's more and more capabilities that are going to come down that are going to benefit the end client. And so the biggest mistake for an advisor is just not to stay up on this space. And that's one of the reasons we're doing this podcast, to make sure, right, advisors, get some information here and are focusing on the right stuff.
So I imagine you have some fairly sophisticated tools that can look at various tax strategies. What are some of the things that an outsourced CIO can do that, say, the internal investment team at an RIA cannot?
Yes. So first of all, I'll go back to another answer, which is purely a focus on how to incorporate tax throughout one's portfolio, how to use all these tools. Now, an investment person within an emerging advisor or a larger advisor, it should be doing the same thing. One area where an OCIO can differentiate is within their tech stack, because to have a integrated technology stack that was built to really match the product out there and to ensure to take advantage wherever you can of taxes, that's a large lift for most advisor groups. We do that. And as an example of something we don't actually have fully implemented yet, but just to give an idea of how we think, munis are a great example. So typically, for most mass affluent clients, you have a model, and a model for non-qualified will have munis. So taxed accounts will have munis and non-tax accounts won't. And that's the way it goes. Well, munis sometimes trade at a premium and sometimes trade at a discount when you take into account taxes. You have to understand where do our constituents live? Are they in a high tax state like New York or California, or are they a low tax state? That's going to make a difference. And then their income makes a difference because munis are priced based on the highest tax bracket. And if you're a retiree, you can have a lot of money and be in a low tax bracket. And so do munis make sense? And so, we're going down the road of customizing. You could still have a model that looks the same for everyone, but, in terms of just the exposures, a diversified exposure to the world, and then based on risk parameters, et cetera, et cetera. So there's that customization through standardization, but then you could go at the next level on, well, when's munis appropriate? When are they not appropriate based on how they're trading versus other like products? And then who should have what within their portfolios? And so, that's really, really, really down the rabbit hole, but that's our job. Our job is to think about that. And then we coordinate within our tech team to make sure that that's possible, because that is not possible manually. You could only do that with tech.
And just to clarify, when you say munis are trading at a premium or a discount, you're referring to what their taxable equivalent yield would be compared to, say, a treasury bond.
That's exactly right, Bob. Right? Just comparing it to something that doesn't have the tax advantage of a muni and saying, where's this priced right now? I believe, kind of going back to your other question, Bob, which I think was such a great question of how do you educate clients to think in after-tax terms? Just looking at two yields doesn't tell the whole story. Looking at two returns doesn't tell the whole story. There's so much more to it. It's so much more nuanced. And the first step is for an advisor to truly understand it, because when you understand it fully and you understand what the initiative and what we're trying to do is, it becomes easier to explain. And that's another item that we do as an OCIO is we put out these thought pieces to really help to define it so that we're just assisting in what's the best practice in going to that end client and really explaining what we're doing on their behalf. Because when you get back to fees, again, clients, advisors have to justify their fees. And one way they're going to justify their fees is by saving their clients a lot of money in taxes. And those clients will be really, really happy with it. They'll get excited about it.
Yeah. So I want to ask two more questions and maybe sort of rapid fire questions where I can get your answer in a minute or less. The first one is this: are we at an inflection point where tax aware advising or investing becomes just expected?
I think we are. I think it's not quite where we are with alts, where I think everybody's talking about it. Apollo's pushing it in every single newspaper and saying, this is it, you got to look at it. But I think it's coming. And as more sophisticated strategies get out there, it's going to be the same conversation as we've discussed on the golf course, where you're going to have a few people playing golf, and one of these people are going to say, hey, my advisor just put me in this. And guess what? My effective tax rate last year was 28%, and the year before was 33%. I saved $85,000 last year, and it's so amazing. And those three other players are going to go to their advisors and be like, why aren't I in that strategy? So I don't think it's as much as in the alts place where the biggest asset managers in the world are pushing out the marketing. I think it's going to come from below, from just experiences by the client.
And what's the one thing that every advisor who's listening to this show should change immediately when it comes to tax awareness?
So as quarterbacks and holistic planners for clients, advisors have so much to focus on. And the investing world is just becoming more complex. Gone are the days where clients should be satisfied with the model only. Those days they're either gone or they're about to be gone. Advisors need to focus on two elements of innovation within tax. One, new products coming into market. We mentioned Calamos. Cash is another one to look at. Those long-short extensions by the likes of Brooklyn, Quantino, AQR, and others. You need to understand what these products are. Those are two different groups. One was exchange funds. One was more long-short extensions. And just stay on top of the products that are coming out of the market today. And two, tech's just going to get better and better. Keep an eye out for that. I mean, we just had an episode on AI, right? So AI is coming out and it's going to put tech on steroids in terms of what tech is capable to do. And so going back to that example with Moonies, like that's around the corner. We're thinking about it. How do we do that? How do we customize more and more for our clients and really make sure tax advantaged solutions are being provided for the masses? So again, new products coming out, focus on those. Tech's just going to get better and better, whether it's within groups like ours or one-off apps. Understand how to use the tech stack to incorporate tech strategies. Really, really important.
And we'll be talking about both of those, the new products and the new technology, in the upcoming episodes in our series on tax planning. So thank you for listening to Advisor Wars with Bob Hoopsher and Joe Halpern. To learn more about Obsidian CIO or Joe's work, we'll include a link to his contact information and to the firm's website in the show notes. You can also find Advisor Wars on Apple Podcasts, Spotify, and YouTube. And we will include a link to connect with us on LinkedIn. Stay tuned for our next episode in this series on tax planning when we discuss the operational playbook, workflows, client conversations, custodial coordination, and building repeatable tax-aware processes. Thank you.
Obsidian CIO sponsors the podcast to further education and critical thinking about the factors that affect markets and investing. And the podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement and with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs.